The intention of this video clip is to give you an overview of Task G of the 2023 APC and to give you a sense of what the markers expected of a candidate in being declared competent on the task. So at the end of the video, I'm going to share with you a competent as well as a limited competent candidate response. So what did Task G entail? On page 9 of the pre-released information, a ChatGPT generated document was provided in which reference was made to fuel price volatility and the fact that in an airline industry this is a key business risk that cannot be passed on to passengers, given the fact that the passengers are price sensitive and have a low propensity to accept costs being passed through to them. Right, and are given that very willing to switch airlines given change to air ticket prices. Then further triggers on pages 17 and 18 of the pre-released information in document 8. On time's jet fuel costs are further unpacked for us. Reference is made to the industry that this is in fact the largest expense that airlines are exposed to on a global basis, and that for on time, based on its 2022 financial year results, the jet fuel price expense was in fact 46% of revenue. So from that one can gather that the jet fuel expense of any airline is a very significant expense and needs to be carefully managed and controlled. But furthermore, in the pre-release, reference was made to the fact that jet fuel is priced in US dollars per gallon. And so a candidate in the pre-release period should have reflected on the fact that if you hedge against jet fuel price risk, you are only hedging as a South African airline operator, only part of your risk exposure. Given that USD is the pricing of jet fuel, one needs to then be aware of the fact that a South African airline would also be exposed to currency or foreign exchange exposure. So, at the end of having worked through document 8 in the pre-release, it would have been very clear to the reader that on time needs to seriously consider at least hedging their jet fuel price exposure, given that it is such a significant cost. But secondly, a candidate should have started wondering, but what about the currency exposure? Now, in the pre-release, reference was also made, and it would have been good had the candidate gone and sourced this article, of an article about Southwest Airlines and its hedging of its jet fuel exposure. In this article, reference is made to the fact that Southwest Airlines, using call options, hedges against jet fuel price risk and has successfully avoided over time very, very sizable losses, which would have resulted had it not hedged against the jet fuel price risk. What then would these call options entail, which Southwest Airlines uses and which on time is considering using? So a jet fuel price call option allows the holder of the option, in other words, the buyer of the option, it provides them with a right to, given that it's a call option, buy jet fuel at the strike or exercise price in terms of the option and not at the market price, being the spot price on a given day, to the extent that that option and its strike price makes financial sense. So the issue with the information that I'm going to show you shortly from the scenario as provided in the pre-released information is that in 3 of the 4 quarters it would not have made sense for On Time to in fact have exercised the option. But the benefit that an option provides is that it can lapse and the loss is capped or the expense is capped then at the premium that was spent in buying the option. And so in document 8 of the pre-release, details around, as I mentioned earlier, the exposure of On Time to jet fuel price risk and the fact that the jet fuel expense represents 46% of total turnover of On Time is given. And a little lower down on that page you will see how volatile jet fuel prices have been historically. But an interesting comment in the pre-release is that the jury is not out as to whether airlines do in fact protect themselves adequately or should hedge. And so as the comment at the bottom of page 17 says, some airlines have elected not to hedge, while others in fact have done, such as Southwest Airlines, and reference then is made to that article in the Financial Times that, as I said, a writer of the APC in 2023 should have sourced and read very carefully. Then a very important issue is addressed in the information on page 18, and that is that the candidate is alerted to the fact that over the period of a year, the call option prices were tracked from 1 July 2022 on a quarterly basis, each quarter being settled at the end of the quarter, the call option premium per gallon and the call option exercise or strike price per gallon being given. In the table just below that, the spot price per gallon on 1 July is given. That is a red herring because that deviates from the settlement date or exercise date on the options. And so what was key here for an APC writer to work with are the spot prices on settlement date when On Time could or might not exercise the option. And just below that is a very interesting statement. Some homework for you. Would it have been better for On Time to have hedged its jet fuel purchases over the period 1 July to 30 June 2023 or not? And so indeed, this is what a candidate would need to have got their head around in that period, is if these options were to have been used, they would have seen that only in quarter 3 does the option create a gain for On Time. In the other 3 quarters, On Time would have incurred the premium, not exercised the option, and have bought at the end of those 3 quarters the quarterly fuel required at the spot jet fuel price that prevailed on that day. And so this is a very good example when writing the APC of you as a candidate needing to do some pre-release work and bring that in with you. So it's not pre-preparing your answer, but calculating here what in fact On Time should have done. Because that on the day would have allowed you to tweak it slightly, as you will see shortly, for the forex risk that is an added dimension to the hedge. But the basics here of hedging the jet fuel price, a candidate could have got their head around that by investing a bit of time into the data on page 18, it would have been good preparation for addressing task G. So what then is the twist on the day? What does the information provided on the day then, in addition to the pre-release, tell us? So it says, On Time has in the past from time to time hedged its forex risk through an FEC. And what is provided then as additional information on the day are FEC rates for the same day. In other words, the day coincides with the exercise date of the call options per quarter for the 4 quarters provided. And these are rates at which On Time could buy the dollars they need to settle their jet fuel acquisitions. And a very important, and that is highlighted in red for you on the screen in front of you, suggestion is made. On Time is considering setting up a partial hedge, in terms of which it is to hedge only 50% of its jet fuel requirements per annum. And you are told that they use 1.8 million gallons per quarter. In other words, the intention is to hedge 900,000 gallons against the impact of jet fuel price volatility, and on the day now, you get told against forex risk. So you needed to default back to your basic knowledge from financial reporting and in financial management, from your financial risk management around forex and currency risk management, as to how an FEC would work. And so what was expected of the candidate in task G? Firstly, comment briefly on whether it would have been cost effective for On Time to follow this 50-50 partial hedging strategy and hedge half of its jet fuel purchases against jet fuel price risk exposure and foreign currency or exchange rate exposure. This implied calculating and weighing up what the results of this hedge would be, either by looking in total at what an unhedged expense would have been over the year versus the 50% hedging of the currency and fuel price risk exposure, and not hedging the other 50%, and then determining whether indeed the hedging strategy would have been cost effective. Then secondly, to identify 2 key, please note key, therefore important benefits, material benefits of using jet fuel hedges, as well as 2 downsides, in other words, disadvantages of using jet fuel hedges. And then finally, to provide an opinion as to whether it would have been feasible for and will be feasible going forward for On Time to hedge through a partial hedging strategy. So we need to unpack the data a little. On the slide in front of you on your screen, you will see the key data. So the total fuel purchased per quarter amounts to 1.8 million gallons. They intend hedging only 50%. So the first sign of competence is a candidate who brings into their hedge 900,000 gallons. The second sign of competence talks to the correct understanding of the call options. Now, the call options give On Time the right to buy jet fuel at the strike price instead of at the actual jet fuel price per gallon, should it make financial sense. They are not obligated, they merely have a right to decide on exercise date as to whether or not to buy at the strike rather than the spot. So let's look quickly at those two columns, columns C and D. If you look in column C and compare it to D, it is only quarter 3 where the call options make financial sense, because it is in that quarter that the jet fuel price has increased beyond the strike price, and you would then exercise the option in that quarter. What would you do in quarters 1, 2, and 4? You have a right to walk away from the option, in other words, to let it lapse. And so in those 3 quarters, no loss is made from the option because you wouldn't strike. But what you would have done is incurred the premium per gallon included or given in column E in those 3 quarters in buying the call option. The premium for the 3rd quarter would reduce the 30-cent per gallon gain that you would get through exercising the option, and that would reduce it down to 22.5 US cents per gallon. So that talks to the jet fuel price hedge. What about the forex hedge? So in columns F and G, you are given the FEC rate on the quarterly settlement date, in other words, the end of the quarter. And if you compare that to the spot rate, you will see that the FEC locks in for quarters 1, 3, and 4 a far lower rate. And that per dollar that you buy would create a gain, a currency gain through the hedge. Many candidates in the marking process were seen to incorrectly apply the gain. So they correctly calculated a gain per dollar for quarters 1, 3, and 4, correctly calculated the loss per dollar between the spot and the FEC rate, so incorrectly forgot that the gain or loss on the currency, in other words, per dollar, needs to be applied to each gallon of jet fuel being acquired. And so that was considered a fundamental error in answering task G. The other fundamental error that was picked up in marking or assessing task G is that some candidates exercised the option in all 4 quarters, creating a loss between the spot jet fuel and the strike price for quarters 1, 2, and 4, and indicating a lack of competence around, as based on the technical competence of how an option works. So in answering part A, or the first part of task G, the candidate could have followed one of 2 approaches. On the screen in front of you is what one would call a total approach. And that compares the cost of the full 1.8 million gallons per quarter, unhedged. So as you will see there, purchasing the jet fuel at the spot price in the market and converting that cost in US dollars to a rand cost at the spot exchange rate at the end of the quarter on that same day. And that gives one a 420.7 million rand fuel expense for on time if it did not hedge during the period 1 July 2022 to 30 June 2023. That needs to be compared with the partial hedge that we are going to set up now. So the partial hedge hedges only half of the jet fuel consumed. in other words, the 900,000 gallons. Through the call options, On Time at the end of each quarter would have the right to compare the strike and the spot. That referred to as actual there. And where the actual or spot price of jet fuel was in fact lower than the strike, On Time would not exercise or strike at the exercise or strike price. They would then elect to rather buy the jet fuel at the spot price in the market to avoid a loss arising from the option. So in quarters 1, 2, and 4, you would not exercise the option. In quarter 3, you would. And so in quarter 3, you would be buying jet fuel at $3 per gallon and not at $3.30. But that gain would reduce then the 30 cents per gallon gain by the premium. And so for all 4 quarters, the premium per gallon would have been necessary to add that onto the spot jet fuel price per gallon for quarters 1, 2, and 4, and the strike price for quarter 3. That multiplied by the 900,000 gallons gives you the US dollar quarterly expense for jet fuel, and given that that would be hedged through the FEC, so the assumption here, listen carefully, is the same 50% of the jet fuel being consumed, which is hedged against jet fuel price risk, would now be hedged against the forex risk. And so using the FEC rate per quarter, remember with an FEC, you have to buy your dollars at the FEC rate here. It is not an option that you would allow to lapse in quarter 2, where the FEC rate is in fact higher than the spot rate in the market. And that results then multiplying the US dollar cost out of striking in quarter 3 only and buying at the spot price in the market for quarters 1, 2, and 4, converting that at the FEC rate, gives us a hedged cost of $205.7 million. What we, however, need to remember, though, is the other half would have been unhedged. And so 50% of the 420.7 million rand total unhedged cost needs to be determined. In other words, the 210.35 million, and that gives us a total exposure or cost, jet fuel cost, resulting from the 50% partial hedging strategy of 416.134 million. Comparing that to the unhedged cost results in a net benefit having been achieved of 4.566 million rand. Now, what is important to note from this scenario is that the main reason for this gain is the fact that the FECs protected On Time against far more forex risk than the jet fuel price risk that arose. And so the main contributor contributing 5.125 million rand of the 4.566 million was the FEC. Now, to be declared competent, you did not have to go and break down the 4.566 million into those two portions. In other words, calculating a loss from the options over the 4 quarters and a gain, a net gain of the FECs across the 4 quarters. That you didn't need to do. But had you identified that the FEC was the main driver for this overall net gain, it would have definitely displayed a higher degree of competence for the marker. Now, as I said to you, there's a different approach you could have taken here. and that is to isolate and to look at the option on its own and to calculate a net loss in US dollars per gallon from the option, to multiply that then by the 900,000 gallons per quarter, and to then convert that into a rand equivalent amount. So, what then would the net gain or loss per quarter be from the option? So for quarters 1, 2, and 4, you would incur the premium and no further loss would arise. So in quarters 1, 2, and 4, you would need to convert the dollar, in other words, denominated in US dollar, the premium per gallon, at the spot exchange rate, and on that basis get the cost, the hedging cost per gallon in rand terms. Multiplying that out by 900,000 gallons for each quarter would give you the rand cost incurred through the option. Quarter 3 is the one quarter where you would exercise the option. That resulted in a 30 US cent per gallon gain, being the difference between the spot and the strike price, less the premium paid for the option per gallon for that quarter, results in a 22.5 US cent gain per gallon. That converted at the quarter 3 closing spot price at the end of the quarter times the 900,000 would give you the gain in quarter 3, and the net of those 4 quarters would give you the 559,575 loss generated or created from the option contracts. Now, determining the gain or loss from the FEC. Per quarter, you are given an FEC and a spot rate at the end of the quarter for the same date as the FEC is settled on, and you could calculate a rand per USD loss created through the FEC. So that would be in quarters 1, 3, and 4. In quarter 2, there is a loss through the FEC. And so that would then be calculated as the difference, like you calculate the gain, between the FEC rate and the spot exchange rate on that day. Now we need to multiply that by the 900,000 gallons, but there's one variable that we would need to bring in addition to that. And this is where a lot of candidates fell flat on the FEC. The fundamental error of ignoring the price per gallon of fuel. So remember, the dollars I need are a function not only then of the number of gallons, but it includes then the price per gallon as well. Now remember that we are hedging those 4 quarters, the price per gallon, through the call option. So in quarters 1, 2, and 4 of the call option, you would be buying fuel at the spot price per gallon, but you would on top of that incur the premium per gallon. So the spot price per gallon plus the premium per gallon would give you a USD price per gallon per quarter for quarters 1, 2, and 4. In quarter 3, you are buying the fuel at the exercise price, on top of which you need to add the 7.5 cents per gallon premium, and that you multiply by the 900,000 gallons at the gain in quarter 3 between the FEC rate and the spot price, spot rate for the currency, and that gives us an overall gain then through the FEC of 5.125 million rand. That would have been what one could term an incremental approach, isolating the gain or loss from the call options from the FEC outcome, and then bringing them together, they net off to the same net gain of 4.566 million rand. Both approaches were marked as correct. However, when you made a fundamental error, and the main two fundamental errors that we saw were the call option being exercised throughout, which is wrong, with the FEC ignoring the jet fuel price per gallon that the FEC would apply to, and a third fundamental error that we found was some candidates calculating the outcome of the FEC in rands, the outcome of the options in dollars, and offsetting the loss in dollars against a rand gain on the FEC. So those three fundamental errors detracted from competence on task G. Now, what did you need to address in terms of displaying competence around the key benefits and downfalls or shortcomings of a jet fuel price hedge? Remember, you needed to focus on the jet fuel risk here, price risk, and not on the forex risk. So firstly, through locking in through the hedge or fixing in a jet fuel price per gallon, the company on time would be in a far better position to accurately do forecasting and to price its air tickets, because there is less volatility in the jet fuel expense because we're hedging it, so there is less of a need to pass those jet fuel price increases onto customers who are unwilling to absorb them. Then secondly, through hedging, we are applying or adopting a risk management strategy to reduce our risk exposure. So that is a further key benefit of a partial hedging strategy here, particularly then around the portion dealing with the jet fuel price and protecting on time against that. And then the third theme is airlines that hedge against jet fuel price risk would be in a better position where the jet fuel price does start increasing than their competition, and would, in setting up a jet fuel price hedge, obviously create a competitive advantage and protect its profitability. What are the downsides resulting from the jet fuel price hedge? So number one, the difficulty in predicting where jet fuel prices are going to go to, and once having tried to perform a prediction, then setting up the hedge. Then number two, just as it is difficult to predict what position to take up on a hedge, and to hedge costs that we are uncertain as to where they're going to go to can result in an ineffective hedge, so this ineffective hedge can reduce your competitive advantage, where during times when no hedge was required, on time went ahead and hedged. The third aspect is that one needs experts or people with the necessary skills to set up hedges. And so on time would have to appoint these skills, or at least outsource their hedging to a third party that is reputable and has the necessary expertise to set up these hedges, should they decide to outsource the hedging. And then finally, certain of the hedges, such as fuel price futures, crude oil futures, require the payment of an initial margin to the JSE, whereas with an option, there is the premium to be incurred. And so on time would need the cash flow to be able to make these payments up front in setting up the hedge. The third part and final part of the task was that candidates were asked to provide an opinion around whether it would be feasible to set up a partial hedge, hedging only part of their exposure. And so what were the themes that we were looking for here? So the portion that is hedged creates a form of insurance against jet fuel prices moving in an adverse direction, and if they hedge the currency simultaneously, rand volatility. And so this insurance limits the downside risk for on time. Then number 2, the fact that a portion of the jet fuel purchases are not hedged allows on time from time to time to make use of and exploit favorable conditions in the market that might arise from time to time where you don't want to hedge. And then finally, the final principle before we have a look at a competent and a limited competent response is to say that one thing that one wanted to have coming out clearly in this reasoning around the feasibility or unfeasibility of a partial hedge is that on time would need to consider not only hedging jet fuel price risk but also forex risk. Now let's then have a look at an example of both a competent as well as limited competent response. So let's have a look at what a competent, and it is a solid competent response, looks like. So in responding to part A, or the first part of the task, the candidate goes in Excel and performs various calculations, which we will turn to shortly. What the candidate does is they say here, it seems that the call options would result in a net loss other than in quarter 3. So here there is evidence creeping through that the candidate does understand how an option works, because they then go on to say, however, in those other quarters, the call option having been purchased and the premium being paid on it would increase the price of the fuel that we have to pay. In other words, the candidate is implying here that on top of the spot jet fuel price in quarters 1, 2, and 4, you would have incurred the premium. So one is starting to get a warm feeling about this candidate, but it will be confirmed when we look at their Excel. The currency hedge resulted in a net gain based off the purchasing of the foreign currency at the FEC rate, the candidate implies here, which is true. There is a net gain, but we'll need to see how much it is. Now, what is very key is the candidate then says that on time would have incurred a cost through the partial hedge of 416.1 million rand. Now that should ring a bell, because on the slide where I showed you what the total approach entailed, you would have seen that the total outcome of a partial hedging strategy resulted in a 416,134,035 rand cost. This candidate is saying it would have cost on time 416,126,385 rand. So there's a slight difference, and we'll go and look at what that resulted from shortly. As you will see, it was driven by an assumption that the candidate made that was accepted as valid by us as markers. And so the candidate concludes here and says, based on a total expense unhedged of 420.7 million, which is the 100% correct figure for the unhedged position, they would have made a gain off a partial hedge. In other words, it would make sense. Now, turning to the PDF version of their Excel spreadsheet, candidate competent does the following. So, the candidate firstly in column B provides the premium per gallon, which is correct, the call option price per gallon, and the spot jet fuel price. Then the candidate correctly goes and weighs up per quarter whether it is worthwhile exercising or whether on time should just let the option lapse. And so the first sign of competence here is that the candidate correctly identifies that in quarter 3, the option should be exercised and not in any of the other 3 quarters. And that would imply that in the remaining 3 quarters, as I said earlier, you would buy the jet fuel at the spot jet fuel price. Now, candidates that generally were declared limited competent firstly displayed a lack of competence around the option and went and in every single quarter exercised. We could see that because they calculated a loss between the call option strike price and the spot price, which is totally incorrect and shows a lack of technical understanding of how an option works. Candidate competent correctly then goes and says in the next column there that we will buy fuel at the spot price other than in quarter 3 where we will buy it at the strike price, but in addition then to what we pay per gallon based on spot or strike for fuel, we need to go and add on the premium. Competent candidate takes that price per gallon, including the premium, and multiplies it by the gallons per quarter, but initially you will say they use the total gallon quantity. You are quite correct, but wait until the very last column where they prove their competence. So, competent candidate multiplies then the price per gallon by the 1.8 million gallons per quarter and gets the total cost of fuel from July 2022 to 2023, June, hedging using the option. But it's based on the full gallons consumed. Competent candidate then multiplies the spot price per gallon and says that would be the unhedged price. That is correct. Multiplying it by, again, the full 1.8 million, and that then gives us the unhedged cost. What candidate competent then does is, in looking at the third column, rather the final column, they then make an assumption here, and this is why they make a mistake, and it's not a mistake, but arrive at a different answer. So this candidate, firstly, as you will see here, references each column that they use, and it is easy to follow what they're doing. Those candidates that are found to be not competent make it very difficult in a question like this for a marker to follow what's going on in their head. So what this candidate now assumes is a partial hedge would involve hedging half of the hedged portion and half of the unhedged portion. So they're creating a hybrid between the two, which is acceptable in terms of an assumption. And so what the candidate now does is they take the half which is hedged, or the hedged portion, multiply it by a half to get the 900,000 equivalent cost of the hedged portion, and then a dollar cost for the 900,000 unhedged portion by multiplying it by a half. And they then go, and this is an important feature of competence, bring in the FEC now, which was given on the day. Competent candidate then takes 50% of the total exposure to jet fuel, which is 50% hedged and 50% unhedged. That is the final column value in the table at the top of their spreadsheet, and determines 50% of that and hedges that against Forex. So they convert that at the FEC rate and arrive at the hedged foreign currency amount. For the unhedged 50%, they take the total cost column based on the jet fuel amounts, multiply it by 50% to get the 50% of the total exposure, and they then say that 50% will not be hedged in terms of an FEC, and they translate or convert that at the spot exchange rate on settlement date. Those two columns then get added together, and that is how they arrive at the total hedged exposure in rand terms of 416,126,385 rand. The unhedged fuel bill multiplied by the spot exchange and not the FEC rate gives you then the total unhedged or without hedge amount, which is in the last column, which they 100% correctly calculated at 420.7 million rand. So, whereas our suggested solution hedged the same 50% against both jet fuel price risk and currency risk, competent candidate went and hedged 50% of the total exposure, being half hedged and half unhedged against currency risk, and 50% of the jet fuel price risk hedged amount, and the 50% of the unhedged amount was not hedged against currency risk. And that is why they then went and translated the latter at the spot instead of at the FEC rate. So it was the assumption they made regarding the FEC and what portion of the exposure that hedged, which yielded a marginally higher benefit than the SICA solution indicates. So the candidate here, based on their calculations, is a solid, competent candidate based on answering the first part of the task. Right, so let's see if they say anything which could push them to a high level of competence. So let's go back then to their further discussion. So competent candidate correctly indicates that through mitigating risk by hedging, jet fuel price fluctuations would reduce to an extent, and through locking in through the hedge a jet fuel price on time could accurately budget and forecast for its jet fuel costs. Then secondly, the candidate correctly identifies that through hedging, on time could be creating a competitive advantage for itself, in that through managing its jet fuel cost bill or expense more effectively, they could more effectively price their airline tickets and not have to try to transfer onto the customer the losses made through a lack of hedging. And that would create a competitive advantage for on time. On the downside, there is a risk then that on time would not be able to capitalize off a drop in the jet fuel price, or a strengthening rand, and would have unnecessarily hedged. Right. And so they would be incurring an avoidable hedging cost in that process. And then the second, also valid, all of these comments up until now have been valid and display competence, is there is a risk that on-time staff are not accurate in predicting the jet fuel market prices going forward, set up the hedge incorrectly, resulting in an ineffective hedge, resulting as a consequence thereof in hedging losses, impacting on profitability. And then, does competent candidate display competence and an understanding of partial hedging? So competent candidate starts off by saying, it is advisable to rather partially hedge than fully hedge, as some of the risk of losses and not the entire exposure would be hedged. Right, which is true, and allows then for you to speculate when the market moves in the opposite direction. Right, so firstly, it's very clear that they are only hedging part of their exposure. Then secondly, the candidate correctly identifies from their setting up of the partial hedge and calculating the cost effectiveness thereof, that in a South African context, hedging the currency risk is just as important, if not maybe even more important, as they later say, than hedging purely the jet fuel price risk. So the candidate displays competence and a good understanding that there are two risks and exposure to two risks that need to be hedged against. And then finally, the candidate correctly states that given the uncertainty around the outcome of the elections in South Africa this year, the rand may be more volatile than it normally is, and as a result of that, there is more volatility in the currency, and that definitely then would need to be hedged. Right. So the candidate number one provides an opinion. It is clear that they understand what partial hedging involves, and they also are very clear in their understanding that in setting up a partial hedge for a South African carrier, you would need to hedge both the currency risk as well as the jet fuel price risk. And so competent candidate displays a very solid level of competence. A very good response in terms of the calculation, a good response as well in terms of the up and down sides, and a competent response here in terms of providing their thinking around the setting up of a partial hedge. And finally, that brings us to an example of a limited competent candidate. So in front of you, you have then the particular candidate's response, and the first part of it refers then to the effectiveness of a partial hedge. So the candidate starts off by saying that with call options, based on the information provided, on the 1st of December 2023, it's actually the 31st of December, you would only have exercised that one option. That is right. But we are unable, from the candidate's response here, to see whether then, based on quarter 3 that they're referring to, what precisely they would be buying the jet fuel at, and whether for the other quarters they took into account that while you didn't exercise, you still incurred the premium. So let's see what the candidate does. So at the end of the quarter ending March then, that is the quarter where the option is in the money. The candidate says you were going to make on the gain you were going to make on this would have been 80 US cents per gallon. That is incorrect. Right, it is 30 US cents per gallon gain. So we cannot give the candidate credit for calculating the correct gain there, even. Then the candidate translates that into rands, then correctly says, but this would have reduced for the premium. So in that quarter, we can see that they calculate or apply the premium correctly, translating that as well from dollars into rands, and they get then a net gain of 13 rand and 10 cents per gallon. Now the problem that one has here is, what about the other 3 quarters? So while the candidate correctly does not exercise the option in the other 3 quarters, we cannot see at what price they would be buying jet fuel, and neither can we see whether in those 3 quarters they understand that the premium would have been paid and that cost per gallon would have been incurred, because there is no evidence here of their understanding as to what happened in those 3 quarters. They then multiply that gain that they supposedly calculated of 13.102 rands per gallon by 1.8 million gallons. There is a further lack of competence being displayed, because the partial hedge entailed only hedging 50% of the jet fuel purchases on a quarterly basis. Right, so the candidate ignores the 50% partial hedge that needed to be set up. And then they incorrectly conclude here that on the call option it would have been cost effective. But they have only factored in the gain in quarter 3. They have ignored the hedging cost in terms of the premium in quarters 1, 2, and 4. So there is a lack of competence displayed around the option. Now let's see whether the candidate redeems themselves in terms of the FEC. So what the candidate does is they correctly calculate per quarter for quarters 1, 3, and 4 a gain per dollar made through the FEC. They furthermore correctly calculate a loss in quarter 2. But what the candidate fails to do is to realize, number 1, that this gain is in rand terms and is per dollar, and that dollar gain or the rand gain per dollar ignores the gallon cost of fuel. So if they were to go and multiply that rand per US dollar gain made through the FEC, the net gain over those 4 quarters, by the 1.8 million per quarter fuel consumption of the airline, ignoring again, we would assume, the 50% partial hedge, they ignore the cost of the jet fuel in that process. So there are 2 gaping errors made here. Number 1 is the incorrect currency that they are referring to here, in which the gain has been calculated. And number 2, the fact that they are ignoring the impact of that gain per dollar and applying it to the cost of the jet fuel per gallon, as well as the premium then per quarter that would have been incurred. So that aspect is also lacking. So from the first part of this task, which was very important for the market in assessing competence, This candidate has a limited competence that they've displayed around the option and a limited competence around the FEC, given that they've ignored the jet fuel cost per gallon in the calculation and have not applied the gain to that dollar cost, never mind ignoring how much fuel would be hedged through this partial hedge. So based on the first part of this calculation, this is an LC. Now around the valid key benefits or upsides, the candidate starts off by saying that since, and they imply jet fuel is the most significant cost for an airline, the hedging strategy can determine if an airline is successful or not. Now, what precisely is this candidate referring to here? One is uncertain whether reading this, whether an ineffective hedge would cause the downfall of an airline, or whether a successful hedge would do that. It is not clear, and so the candidate here does not display competence through the packaging of their response. And then they say gains on these profits can allow used to buy more quantities for future use. By what? So what I think the candidate is implying is that the gains made through the hedge could allow them to buy more fuel. But if they're not going to use it, why would they do that? So both of these key benefits, given the wording used here, are not valid and not competent. The key downsides, fluctuations are rapid and huge. If a person has an FEC, they can make a huge loss. Now, remember that it is unlikely that you will make a loss through an FEC, which will be huge over time because of the rand being so volatile. So in other periods, as the case was here, gains would have been made. So it is not valid to suggest that only losses will be made through an FEC. In this case, 3 of the 4 quarters yielded a gain or a benefit for the company. So that point is also not valid. And then what does make some sense here is that cash needs to be utilized. In other words, there needs to be enough liquidity to make the premium payments up front, as these then would be used, the candidate should have said, for the purchasing of the options. So unfortunately, given that those 2 benefits are not compelling, and the only one downside is the candidate has displayed limited competence around the key benefits and downsides that they were asked to explain. Their opinion, this method of hedging will cover on time on all fluctuations, as these fluctuations normally move in opposite directions. The candidate is not displaying through saying that any competence or understanding of a partial hedge. So they are not understanding that through the partial hedge, there will be a portion of jet fuel consumed that is not hedged against either forex differences and volatility, nor against jet fuel price movements. Then secondly, they say this guarantees profit in each one of the hedging strategies. No, over time, you will be insuring part of or creating insurance for part of your exposure and not hedging the other, and therefore you will be speculating on a portion of the jet fuel consumed. That is not clear here, and there is never with a hedge a gain or profit guaranteed. And they then, based on this very thin opinion, conclude that it would be advisable to partially hedge. And so sadly, and I emphasize sadly, this candidate has displayed limited competence across all three parts of this task. Thank you for listening to me, and I hope that you have a better understanding of Task G after having listened to my explanation of it.